We have Joel Farrell on with us today to talk a little bit about mortgage as he works for Fairway Mortgage and he has a few other interesting things to bring us for you house hackers out there and people trying to get into the investment world of real estate. So welcome aboard, Joel.
No, man. Thanks, Paul. I appreciate you having me on. The real estate, it's a path to the everyday person that can build wealth, multiply wealth. And, you know, the language of finance is the language of the rich. So if you know the game, you know finance, you know how to make a plan, execute the plan, it's going to give you a leg up on the rest. And so I'm just pumped to dig in.
Yeah. So first, tell the audience a little bit about you, what you do and where you're from.
Yeah, so I been in the mortgage business since 2006 after I got out of college, and I've got a real estate portfolio that I built from the ground up, 15, 16 units, here in St. Louis, Missouri, where I live. So a couple of multifamily properties, commercial property, single family, a short-term rental in Florida, also a land development in Florida that I'm, working through. So, um, but one thing about real estate, right? It's a long game, and there's struggles and there's failures that come along the way, and um, you know, I think it's important to talk about too along the way because it's easy to have one thing go wrong and then just stop, right? But when you look at the entire blueprint and the entire time frame of things work 5, 10, 20 years on the long range, things work out in your favor if you have that broader perspective.
Yeah, definitely. So let's cover a little bit about you as working for an in-house mortgage company, the difference between the mortgage company and if you were going through a broker, and why that may be important.
So I think it's important to talk about things from a little bit of a broader perspective, right? Because markets change.
Mhm.
You know, pre-COVID, 18, 19, rates were in the fives, fours. And then a few years before that, rates were in the low threes. Like coming out of 2016, rates hit 3.25, which is pretty much the all-time low. So in 2012, 3.25, 2013, got down back down to 3.25, 2016, 3.25. Like that has always been the floor. So 18 and 19, rates were in the fours, fives, upper threes, kind of bouncing around. And then COVID happens, and then that 3.25 floor got broken through because we were in times that we had never seen before. And then you see rates in the twos, 2.5, 2.25. And so when you think about mortgage, it's just like any other type of product that can be, sold. Supply and demand comes into play. How much money is out there? Who can provide it? Who can underwrite it? Who can provide it? Who can execute it? Who can close it? That all comes into play when you're talking about providing a mortgage because you're basically selling paper, selling someone else's money to be able to get somebody into a house. And so, going into 2020 and 2021, if you were in the business, everybody was doing well because people were refinancing and getting to lower rates, which, from an originator standpoint, if you're closing loans, purchases or refinances, you're making money on the deals. So there was so much demand, not enough supply in all reality. So if anybody in the business, had any type of pulse, you're making money. So when it comes to a purchase, right, deadlines are important. On a refi, there's no deadline. Yeah, you're gonna have a rate lock. Maybe it's 60 days, maybe it's 30 days, maybe it's 90 days. But at the end of the day, they're gonna get your deal done. And so, what's the difference between a bank, a broker, or a mortgage company? The difference is really it comes down to who's doing the loan and who's underwriting the deal and who's doing the work. Uh, on a broker side, you're shopping the deal, you're sending that package out to a different entity to actually underwrite the deal. So you have less control over what's happening on the back end. A mortgage company, it's all done in house. So you're underwriting the deal in house, processing, underwriting, closing. It's all done in house. So you have more control over the deal. And if something happens, you need to kind of realign the assembly line that happens. You can sometimes make tweaks to be able to make things happen faster. So on a purchase transaction, when you get a deadline, and again, no deal is ever simple. There's always something that pops up on a deal. Having stuff in house allows you to be able to get things done. Where otherwise, if you're going through a brokerage shop, sometimes things can't get done on time. On a banking side, it's really apples and oranges, right? And, banks do lending because they have to, not because they want to.
Mhm.
So they have more regulations, more guidelines, more stuff that has to come into play to be able to get a deal done. And we use the word overlay. So an overlay is a rule that a mortgage company or bank will have to kind of go by to satisfy investors to get a deal done on top of the regular guidelines. So typically banks are going to have more overlays to protect themselves on top of the regular guidelines. Whereas a mortgage company is going to have probably less things they're going to have to abide by in terms of on top of the regular guidelines. So, those are just the basics, right? A mortgage company, you're there. Your only job is to do mortgages, right? Where as a bank, commercial deposits, mortgage, these are all things that are part of the puzzle for a bank.
Gotcha. Yeah, so the big part of the picture is that by keeping it in-house, you're able to speed things up and maybe go a little bit more into each client and the product that's being offered. Maybe make some changes or tweaks. Is that what I'm hearing?
Yeah.
Okay.
Yeah. I was on someone's show last week talking about this. Like, if you've got a super vanilla deal that's like so simple, 20% down, it's W-2 employee, you got 60 days to close, you could shop that around and probably call 100 companies and you're going to get 100 different answers on rates. Because again, it's all supply and demand, how they're going to price a deal out. And, you know, you're going to have a lot of people that are going to be able to do that deal simply and easily. And, working for a mortgage company, you're never going to have the lowest rates,
Yeah.
but at the end of the day, people that come to me, they come to me because, hey, most of the people that I work with are looking to be able to build wealth through real estate, and navigating that landscape of getting things done is takes a little more expertise. And so I always say that you know, it's not the first property that's the hardest; it's the second property that's the hardest, because that second property, when you're buying it, and if your goal is to build a portfolio in real estate, that means you're probably not selling that property to have for the down payment. So if you're not selling it, where's the money going to come from? And if you're not selling it, that payment is in your ratios. So then now you've got more stuff going on in your income profile. So if you can qualify on that second one, then you're going to be setting yourself up to be able to have dominoes to be able to do more down the road. And there's some, important guidelines and different types of loans that make things doable in that scenario. But that second one, that's the hardest one. If you can crack that part of it, then, you're setting yourself up for some massive opportunity.
Yeah, so let's touch on that. So what are some of the things that you help your clients with when it comes to getting to that second property? Now, that first property they have in their name, and likely if they're keeping it, they're probably turning it into a rental.
Yeah.
But what are some of the things that they need in order to get to that second property and maybe use some of that rental income for qualifying for a mortgage?
Yeah, this is such an important question. And then the planning that goes into it is really important. And there's a couple different things. Um, the actual point in time when you're purchasing that second property, there are two different types of loans that you can do. One is FHA, one is conventional. Conventional is more sensitive to credit score. FHA is less sensitive to credit score. Conventional allows you to use a proposed lease to offset the payment on that departure property, the departure residence. FHA does not let you do that. So if you're getting to that second property, and you probably, if you're making $200,000 a year, cool, right? Like maybe you don't need to have that lease to offset that payment to help with your income ratios. But if for most people, the numbers are going to be somewhat tight. Having that lease is going to be important, which means that if the lease, you need a lease, you need to do conventional. That means your credit scores need to be good enough. And when I say good enough, 720 and above is kind of where I say if you're over 720, you're probably going to be able to fit into conventional. If you're below 720 to 680, it's gray area. If you're below 680, you're probably going to fit into FHA, which is going to be more flexible guidelines and less sensitive to credit scores. So like building up and planning and having your scores set up is important. And some people may say, well, okay, that's cool. I didn't know that. Or some people say, well, of course you're going to have good credit scores to be able to buy a property. So they're going to have different kind of reactions to that. But it is really important. And then, okay, where are you going to pull the money from to have for down payment? Maybe you're saving enough money. Cool. Or maybe you're pulling money out of the retirement account that you've been stockpiling. Cool. Or maybe you need a gift of funds. Cool. Or maybe you've been in that property for long enough, a couple of years, and you have equity built up. And some people may be able to do a home equity line of credit or a second mortgage to be able to tap into that equity to be able to buy the next one. Now, again, I'm not saying that you should or could or whatever, but that's what people can do. And there are risks in that that are probably for a different conversation.
Yeah,
And
we can
so,
go down a rabbit hole of that. So,
yeah.
yeah.
But before you even get there, the first purchase is even more important, because if you're leaving that property and you purchased in a scenario that doesn't make sense to rent, then that's a whole thing. And so I always ask somebody, especially in the first go rounds of conversations when they're thinking about buying, I ask the question to everybody is, let's say you get into this house and you fast forward the clock how many years and life changes and you have to move. And now the question becomes, okay, what do you do with the first property? Do you sell it or do you rent it and have the visions of becoming a landlord? And different people are going to answer that differently. Someone will say, I never want to be a landlord. Cool. Oh, hell yes, I definitely want to be a landlord. Let's do it. And some people, I'd say probably the majority of people, I never really thought about that. Let me think about it. And then you kind of go into the pros and the cons and you leave it kind of open ended. But the person who says, yes, I definitely want to be a landlord, that gives, the mortgage professional a little bit of an extra backdrop of what their goals and what their intentions are, because that purchase, if it's going to be a short-term type of scenario and it's going to be a rental property in the future, then where you buy, what you buy, how you buy it is going to be, a little bit different than if it's going to be your forever home. They're going to live for 10 years or whatever. And so that first property turning into rental, you want to be very intentional where it is, et cetera. So that part of it, I think, comes into play up front on the first one.
Yeah, you have to look at your exit strategy for that. And that's important in any deal, whether it's investing or even your personal residence, because like you said, when it is your personal residence and say life happens and something happens where you have to move 3 years down the road, and look at what happened today compared to if you bought 3 years ago. Now it's a lot harder to offload that property because it's not worth, that much more, or it's worth less than what you bought it for. Even if it's break even, selling that on the market is you're going to be coming out of your pocket to sell that property.
Yeah.
So
Yeah. I bought my first property in 2009. It was a condo. And that year coming out of the crash, there were some first time home buyer incentives. I think at that point, it was an $8,000 gift from the government to be able to buy a house, because coming out, there was just all kinds of uncertainty. The banks had just collapsed. At the time, I was working for Citigroup, and the stock price in '07 was like $45. And then in '09, you had like 84 cents. And all kinds of just uncertainty what was going to happen. So I bought a condo at the end of '09, and I was scared as hell. And it was $230,000. I was scared because I worked in a job that was commission based, so I didn't know what was going to happen to my income in 2 or 3 months down the road. But I had saved up enough money to feel comfortable enough to do it, and I took the plunge. And at that point in time, like, I was buying in that condo in a certain area, middle of St. Louis, that I knew, hey, if something happens to my job, that I knew I could rent it out, well. I had no visions of building a portfolio. That was never anything that I really thought about until getting into, further in my career and just learning and talking to more people who were doing things. Because again, the internet, social media, it isn't what it was. It isn't today what it was. It's not today, whatever. You know what I'm saying? It wasn't then what it is today. So the examples of people building, of everyday people building wealth through real estate, it just wasn't as widespread in terms of awareness. So I bought my next house in 2013 and then turned the other one into rental, and then did it again in 2017. Then in 17, I actually purchased a couple of 4 families in St. Louis off market, good prices. Purchased a commercial property, with my partner for our mortgage company, because I moved from a bank to Fairway as an employee, and then we decided to buy a building, and then we rehabbed it, and then put our team here, and did a few more things along the way. But it wasn't until 2019 that I started to realize, because the journey, right, like the beginning parts of the 5, 3, 7, 10, however many years, the first part of it, it's hard. You
yeah,
don't
you usually
really
have less money than if you just had a regular job because you're investing it. So
right. It's not
yeah,
all rainbows and unicorns. Like,
yeah,
it took me probably 7, 8 years to, like, oh, I'm refinancing this property. Oh, damn, that thing, the value came in way higher. Oh, and my mortgage balance. Oh, there's equity. Oh, I see it all coming together. Like, it took time,
yeah,
almost a decade.
yeah. So what would you say would be like some of the most important parts if somebody's out there looking to buy their first home or second home, and they do have that investor mindset? So what would be the importance of working with a not only realtor but a broker or lender that um is in the profession too and actually does invest? Would you say there's an edge to that?
Yeah, 100%. I mean, there's people that I talk to, clients that I talk to, that have said to me, like, straight up. There's a client that is a little bit older than me, in his 50s, and he relocated from Hawaii back to home to Virginia, and there was something that popped up, and there was something where somebody was offering him um, a chance to do a refinance at a rate that was lower than anything that anybody could do at that time. There was some bank that was just doing some type of a special at the time. And so he called me. He's like, "Yo, no, I don't want to go elsewhere, but like, what do you think about this rate?" And I'm like, "That rate is like a 0.5% below the market. Like, you should just take it." And what he was doing a cash out to be able to then purchase another investment property at the time. And this is in 2019. And he would call me, ask me questions about what was going on, what the person was saying, and I'd help him, kind of guide him, and help him help them to get the deal done, because they're talking to people who aren't that experienced. And anytime you have rental properties, it gets more challenging in terms of debt to income ratios. And so when the deal was done, he's like, thanks for helping me out. I appreciate it. And it's just never the same working with somebody else than you. And you hear those kinds of things, and you appreciate that. But when you, like I said before, that first property, cool, it's cookie cutter, right? When you start getting into more properties in your portfolio, how you look at the numbers, what do you have to tweak, pay something off, not pay something off? There's just so much that goes into the planning part of it, getting a deal done. So yeah, I mean, if you have that vision of building a portfolio, and there's a lot of people out there that are good, and then there's a lot of people out there that are good that also have that experience, but it does make a difference. And so, just like any other profession, it's good to interview a few different people that you may know or come across, to be able to kind of compare. How are they talking about things? Are they setting a standard, or setting a plan, or setting an expectation level? And people don't have all the answers. And so, does someone make up an answer in the moment, or do they say, hey, I don't know that, and I'll get back to you. I get back to you the next day with an answer, or a week later, and they give you the right expectation. So expectation setting is so important also in this job.
Yeah, and I'm sure you've came across this scenario multiple times. I we'll just go through it. How many people have you had, go to these places that are offering such a low rate and then they can't close on the deal and they're calling you back? Does that
Yeah,
happen?
that happens a lot, and it happens so much, especially in this environment right now. Like in 2024, 2022 happened. Rates went up from 3.25 in December to 6.5 by June. Rates went up so fast, and that also leads to higher debt to income ratios, tighter guidelines, and things being tough to fit into guidelines. And so it happens so much that I even set up a phone line. It's 1-833-9 bat line. So if somebody wanted to get a hold of me on, like, I give that to my agents, partners in different parts of the country, that, okay, here's an easy number to remember. Call me if you have a deal dying. So like, yeah, it happens.
Yeah, and then sometimes deals fall apart because somebody tried to go that route and the seller's just not willing to wait around for them to go through the lending process again.
Yeah.
So,
There's there's one more thing on top of that. Coming out of COVID, right? So many people had things going on in their jobs, and maybe you got laid off, or maybe you didn't work for a while. And so many people coming out of COVID, got into a side hustle or a side business or whatnot. And so, talking about, a business on the side, maybe it comes through as a Schedule C, maybe it's a 1099 that comes through on a Schedule E. You start talking about self-employed, that's a whole nother wrinkle for lending. And if you're just I run a business and that's what I do, like, okay, that's one thing. And maybe you've got your couple 2-year history of tax returns to be able to show your history of income. That's kind of like the typical scenario. But now there's more people doing things on the side. So I may have a W-2 job. And if you also have a business on the side, and you have all kinds of expenses on the side that you're flowing through, and now you have a lower taxable income, I mean, that also comes into play too, because if you make 80 grand, but you have a business that's losing 50 grand, I mean, it doesn't look good on paper. So you can imagine what happens when underwriting sees some of that stuff. So that's a big thing that pops up, and knowing how to kind of navigate those things, and different tools and resources to figure out what to do. So that's a big thing that's come up in the last couple of years.
yeah, I mean, I ran into that same scenario because I've started a business a couple of years ago, and I had a decent amount of debt on my last year's taxes. So it made it look like I didn't, I mean, a decent amount of expenses to write off. So it made it look like I didn't make all that much money. And that made it a lot more challenging to buy the duplex I'm sitting in now because of that. So planning is really big, and working with somebody like you or some other professionals that can help your clients get ahead of those things. So,
Totally.
yeah.
Totally.
But you know what? You have something that you put together that could help a lot of people. You want to talk about your little free access you have to becoming a millionaire.
Yeah. So, actually, I wrote a book, right? How literally anyone can become a millionaire. And It's 70 pages. It's not earth shattering. It's nothing that I would say is brilliant. But it's just stuff that's in my brain that I wanted to put on paper. And, it talks about power of the subconscious, habits and the little things that it takes to be able to tilt things in your edge as opposed to someone else's edge. And then a couple different examples of compounding and, the whole, yeah, if I save $100 a month, over 35 years, you'll become a millionaire. It talks a little bit about that stuff, which it's important, right? But like it also makes me frustrated because I'm impatient as hell. The people that I talk to that are younger than me are impatient as hell too. So no one's waiting to 65 to retire. Like, come on. So
Right.
we're all looking for different ways to be able to accelerate that time frame. But in the book, I kind of give a parable of somebody loosely related to a couple of different clients that have done this, and I called this the stair step method. And again, I just call it that because it makes sense in my head. But you buy a property for say 150K, live in it for 2 years, save up, buy the next one for 250K as a primary residence, put 5% down, turn the old one into rental. So do they again for 350, again for 450. So over 8 years, you purchase 4 properties. And so then you fast forward the clock 20, 30 years, you're talking about $1 million portfolio as your renters are paying things down. And so 4 properties is enough to have a comfortable retirement, to be able to have another lane, another thing that's growing on side of what you're already doing. Because for most people, right, a 401k is just not going to be enough. There's no pensions out there. So having these other seeds planted, is a tool to be able to build wealth. And so I built a guide. I put it out there as a kind of a lead magnet because, I mean, even though it's 70 pages, most people aren't going to want to read 70
Right.
pages. So I built a 2 or 3 page guide that just sums it up. And if it's something that you like and appreciate and you want to dig deeper, cool, we can always connect on it. But yeah, that's a tool that we can, pass out. It's just a Google link.
Yeah, and I'll throw that in the description of this video so people can easily find it.
Cool.
Yeah. Um, Other than that, I mean, I loved where this conversation went. If somebody wanted to reach out to you, how can they get a hold of you?
So my email, actually, I'll just get my cell phone. You can
Okay.
text me. It's probably the best way. So 314-956-1580, 314-956-1580 is the best way to get a hold of me.
Okay. I will throw that in the description as well. And you have a little interesting thing going on Instagram as well. You want to talk a little bit about that before we jump off?
Yeah. I mean, like the biggest question that I have that comes my way in my day job, right? Because I have mortgage. I've been doing this so long, built a podcast a couple years back called Strive for 25. And the whole premise of that is, hey, the people that I'm seeing that want to get into real estate, the biggest limiting factor is not having enough money saved. Well, especially in this high inflation environment, cutting and budgeting, it's not enough. So what are people doing to be able to save money to be able to then go buy real estate? The people that I'm seeing get ahead are the ones that are focusing on income, focusing on how to increase income or a side hustle or a side business or whatever. And so it's just something that I got really passionate about. Okay, what are people doing? Like I'm seeing this person do this. Like I have a client who bought his 5th property last year and he worked in the IT world and he had 3 full-time jobs at one point in time, multi-screening it or whatever. I don't know. And he was just stockpiling cash and he did the stair step method and started in North Carolina, then to Texas and this and that. And so did this exact same thing. Now he's, can pull off the gas pedal a little bit. And now he's got 5 properties with 4 rentals that now he can kind of just, okay, reset, recalibrate. Okay, let these things grow and just kind of just, go about it. But the point of it is that I'm counting up to 100 different stories of people increasing income and side hustles and just accumulating these stories to be able to share. And then like we had you on a couple of times
Yeah.
and then a 1 or 2 page guide to come along with it just to give somebody a quick roadmap.
Yeah, that's awesome. I really love what you're doing. So is there any final thoughts you want to leave my audience with?
Yeah. The, the biggest struggle that I see right now is what do I do? Like if you're a first time home buyer, when I started in the business in 2009, the S&P 500, was, coming from 150 and then it tanked to 80 and then it surpasses that a couple of years later. And now the S&P is 500 or whatever. I mean, it's more than tripled. Home prices, the median home prices have more than doubled in the last 15 years. So the question is, I mean, is this the right time to buy real estate? Prices have come up so much. Is there going to be a crash? What's going to happen? And it's such a tough conversation because we're kind of dealing with a new normal. I mean, we've never seen, this many trillions of dollars get pumped into the economy coming out of COVID in the entire history of this country. So we're talking about fundamentals, infrastructure that's never happened before. And so I don't think really anybody, can be certain of what's going to happen. But from a supply and demand standpoint, so many people, I think they're like the percentage of people that have a rate below 4% or have a home that's paid off is like 70% of the amount of households out there. So is there going to be a crash of real estate? Well, that would mean that people will need to be selling, a lot of their, a lot of the inventory wants to need to be on the market to sell. And when people are have homes that are affordable, it doesn't put a lot of pressure on the amount of supply. So there may be a downturn, there may be a drop in prices, but at least right now, I don't see a major, pressure for a major crash. So if that is true, which again, it's my humble opinion, then what's going to happen over 5, 10, 20 years of home prices? They're either going to be stable, flat, or they're going to go up. And if prices go up, what do you do then?
And even if they are flat, well, then you have 10 more years of mortgage pay down and you're not renting. So,
That's right.
yeah. And this is new. You're the first person I've asked on this on any of my guests. Out of any YouTube channels you watch, it doesn't matter if it's real estate investing, what is your favorite YouTube channel that you watch?
Um, that's a good question. So I'm in a season of my life right now where I've got so much going on.
Yeah.
I got two boys that are 4. Mortgage business is in the worst state it's been, since I've been in the business. Trying to do this thing, that thing with the podcast. I'm more spending more of my time on my podcast part of it, and it's not really informational. It's more reminders. Like the
Okay.
people that I'm listening to is Alex Ramosi,
Okay.
because I'm in a growth stage, trying to be able to grow my mortgage business to be able to keep things going. So
Yeah.
give to the ask mindset of giving away guides and giving away tools and just trying to create that goodwill with my audience is what I'm trying to be able to do more. So Alex Hormozy's stuff is something that's really been an important part
Good.
of the
Yeah.
journey.
Awesome. Well, Joel, I really appreciate you coming on and giving me some of your time. And we'll probably be talking here in the future.
All
So
right. Thanks,
thanks
Paul.
again. All
Appreciate
right.
it.
Bye.